Money FM 89.3, best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap. And we've got red on the screen to start things off. And this comes through after a choppy first trading session of the new year. The blue chip Dow trading down 152 points or 0.4% lower to 42,392. The S&P 500 slightly lower by 0.2% to 5,869, while we have the Nasdaq Composite also down 0.2% to 19,281. So for both the S&P 500 and the Nasdaq, they are now down for 5 straight sessions, their longest losing streaks since April. For more insights on what's playing out in the markets and the global economy, we've got Mark Matthews. He is the Managing Director and Head of Research for Asia at Julius Baer. Good morning, Mark. How are you doing this Friday morning?
Oh, I'm doing just fine. Thank you, Ryan. And yourself?
Doing great as well. And of course, a happy new year to you, Mark. Hope things are getting off swimmingly well. Let's see how markets have been playing out so far. And we've got tech showing a bit of a mixed picture. Apple has been down 2.6% in the latest session. Tesla down 6% as well. On the flip side, Nvidia's up 3%. So let's start there with tech in focus. Where do you see things playing out for some of these big tech names right now?
Well, as you know, we've just started a major revolution, which is generative artificial intelligence. And when I say we just started, the adoption rate for generative artificial intelligence is still only about 15% of people who are using it in the United States. Now, that's sort of like where Netscape Navigator was back in 1996. Now, they released it in December of 1994. So by around 1996, the adoption of the Internet in America was about 15%. And as I said, that's where we are today with ChatGPT and the other Gen AI. But what I want to say is that back in 1996, we didn't have that many Internet stocks. And when you think back on those days, everybody was talking about Dell or Qualcomm or Cisco or Intel. What you really wanted was the companies that didn't even exist back in 1996. Amazon, Google, Facebook. So I think what's going on is generative AI is very big. It's just getting started. But the companies that everybody's talking about, be it an Alphabet or a Meta, they're probably not the ones that are going to make the big money. The ones that are going to make the big money, they don't exist yet.
Yeah, that's a very good point to make because we are just at the start of where things could potentially go, the early innings, so to speak, because the applications of all these technologies are still yet to be seen. And like you pointed out, just like the internet early days, we haven't really seen the, software companies we've seen today. And many of these social media companies are still quite young. So on that note, there has been a lot of promise with AI, how they could spur productivity, how they could be good for the economy. So looking at the global economy, where do you see things right now? Because there seems to be also a lot of rising concerns with what's in the backdrop, geopolitics, a new U.S. administration. What's on the top of your list of things to watch out for in 2025?
Well, a recession is the last thing to worry about. And the reason I say that is that we had so many rate cuts last year. I don't remember how many central banks cut rates last year, but almost everybody did. And as you may know, it takes around a year for rate cuts to feed into an economy. So if they kind of started back in June with the European Central Bank, and of course others followed, including the Federal Reserve in September, that should start hitting the economy, I'd say, around the second quarter of this year and then throughout the year. So we know that the economy is going to be good because of all the rate cuts from last year. But on top of that is the Trump administration and all of the things that they are saying they're going to do. As you know, he's a real estate developer. You can't get more pro-business, pro-market than a real estate developer. But some of the things that they're talking about are very inflationary. Tariffs, tax cuts, deregulation. It could be very inflationary. So the risk this year is of inflation. And I think we already got a taste of that in December when the Federal Reserve had their meeting and came out much more hawkish in the statement and the press conference than people had been anticipating.
let's take a look at where things are when we look at what the yield curves are reflecting. And we've been seeing 10-year bond yields creeping up. And worth noting, of course, where the Fed is in terms of, I suppose, market expectations. There's now rising expectations they could just hit the pause button this year. Where do you see things going?
I see this as the major issue. I mean, if you look back in history, every single other time that the Fed went into a rate cut cycle, the 10-year Treasury yield went down. And that makes complete sense because usually rate cut cycles last quite a long time. They last over a year. This time, almost to the day of the first rate cut back in September last year, the Treasury yield actually started going up instead. And we're back up to about 4.8 today. I think a year ago, the consensus was that it would be about 3% right now, not 4.8%. So that tells you that this is not a normal rate cut cycle, the kind that does last about 12 to 14 months. And very possibly, December was the last cut.
Okay, so we are looking at yields right now for 10 years at around 4.56, which is somewhere near 6 or 7 month highs. Now, what's the implications for Asian markets when you look at the strength of the US dollar and where money's flowing these days?
Yeah, thank you for correcting me, Ryan. You're right, it's not 4.8, but 4.8 I'd just add as our forecast for the end of this year. But 4.5, is that what you say it is? Asian markets, obviously what's going on in the U.S. Has a tremendous impact on us, but we have our own things going on the ground too. I think the biggest thing out here will be the incrementally more business positive kind of news coming out of China with stimulus. And I know that the Chinese market started yesterday on a bad note, but I still think that there is a lot of upside in that market because the government is clearly turning more pro-economy in its policies and because it's still a remarkably cheap stock market.
Yeah, Chinese stocks posting their worst start to the year in nearly a decade. It does look like investors are pricing in quite a bit of, I'm not sure, bad news. Is that a way to describe it, Mark?
Well, it went up over 20% last year, the Hang Seng Index. If you include the dividend, that's the total return. So, I mean, I just think that, when things go up a lot, they need to come back. But I feel it still looks quite good. And earlier you mentioned the dollar. You would think that, if the economy is so strong and we have inflation, that all of the things that you and I just talked about should mean a stronger dollar. But, currency markets and financial markets, they price things in well in advance. So the dollar has already risen a lot over the last month or so. And I think it's already priced in the stuff we were just talking about. So I don't think the dollar will continue to rise. And if it doesn't, then if it even goes down, that would be a positive force for Asian markets.
Yeah, Mark, like you pointed out, it does take time for things to trickle through, both for interest rate cuts as well as the Chinese stimulus measures. So a lot to watch out for in the year ahead. We've been in conversation. Mark Matthews, he's the Managing Director and Head of Research for Asia at Julius Baer. Mark, always a pleasure chatting with you and have a great year in advance.
Thank you. Happy New Year, Ryan.
Happy New Year, Mark. Stay at Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.